Hello, everyone. This is Andrew Berman from National Mortgage Professional Magazine and Mortgage News Network, coming to you from the M&N Studios. I'm so excited for you to join us for another Mortgage Leadership Outlook. We've been having some of the biggest and brightest minds in the mortgage industry meet with us every day, 4 o'clock East Coast time, do it Monday through Thursday. Just a great lineup of people this week. And today I'm super excited to bring you someone who's right in my backyard, right here in New York. And he's a banker maverick. I'm just going to call him that because when you think of actually a bank, you don't think of someone like my good buddy Steve Schnall. Steve, thank you so much for joining us.
Hey, thanks. My pleasure. Thanks for having me here. Love your show.
Appreciate it. Listen, before we get started here, I got to ask you a big question. So, are you nervous about Bobby Axelrod getting into the into your space, into the banking world? I don't know if you saw that, but
I did. Yeah, I'm a fan of billions. No, I'm not threatened by Bobby. We could take him on.
That's great. Yeah. Which, by the way, if anyone didn't see the episode, we just ruined it. We've just actually. So, I probably should have put a spoiler alert graphic, but it is what it is. So listen. If you don't know, Steve and Quontic Bank is a bank that's based right here in New York. So they're literally just hopping on the Long Island Railroad, and I got to take to get to you, railroad, and then one subway, and I think
you're going to Penn Station, and then you're going to walk.
Yeah, take a walk. Right. So, and he's in Rockefeller Center. Like your office, like you look outside your window, you're at Rockefeller Center, right?
We are. We're at One Rock, as we refer to it, and literally right outside our conference room is the ice skating rink, and during the holidays, of course, the Christmas tree and hordes of people, but not today.
So yeah, and listen, I'm curious if anyone is watching this and you've been to Rockefeller Center. So if you know what it looks like, if you've been, whether it's ice skating, please comment down below. Let us know actually if you've ever been there. And listen, Steve, would you mind taking us I'd love to see what it looks like now. So here we are, 4 o'clock
Sure.
on a Tuesday. I gotta imagine like this would normally be absolute chaos. So everyone, we're gonna actually get a live view of Rockefeller Center right now. One Rock.
So here is the skating rink. Nobody there. Here's the plaza. Not a soul. Wait, there's one lone person, and of course the police. There's Del Frisco's where I walk for lunch every day, and that's about it. There's nothing going on here. New York City on lockdown.
Wow, I used to work a few blocks away from there, so really familiar with that area. And to see it just with no one there in daylight hours, to see it at any time actually where there's no one there, that's just phenomenal. So right now, I would love to talk about what you guys have been doing at the bank. So you're there working. I see that when we've talked, you've been at the bank. What is your kind of your new norm? How are you handling the social distancing and the new rules that we're working within?
Well, banks, as you know, are deemed essential, so we are allowed to be open. But that said, we were probably one of the first banks to deploy a totally remote workforce. So we got out ahead of it. We purchased about 100 laptops early on, and as soon as this pandemic started to gain some speed, we sent everybody home, and we executed pretty well. Business as usual occurs. The checks clear, deposits are made, mortgage payments are processed. Everything happens business as usual, but nobody's here. So we love our new offices at Rockefeller Center. We moved in last year. And now we have a 20,000 square foot empty floor where it's me and 3 other people. And so a few members of our senior management team come in every day, and we get the job done.
Wow. Yeah. So so you just moved in. You must be excited about going to the office now. I mean, to be in an iconic location like One Rock. And where were you previously?
Headquarters of the bank prior to this was in Astoria, Queens. When I purchased the bank in 2009, it was located in Great Neck, Long Island. We didn't have any particular connection to that market, wanted to move it into New York City, but at the time the bank was just too small to be able to exist in Manhattan. So the next best move for us was Astoria, Queens. It's a great ethnically diverse neighborhood. My chief lending officer lives there and had run a very profitable division of my former company there. So it seemed like a logical place to start to get ourselves into the city. And of course, last year, banks gained size. We've got a lot going on. And it just seemed that if we wanted to really become the truly digital bank that we were striving to become, we needed to be in the heartbeat right here in Manhattan. So when I walk in the door every day, I'm proud of the space, but all I see is the $100,000 a month rent going out to house 4 people.
Oh, that's tough. That is tough. So how'd you get into this gig? Like, talk to us a little bit about your very typical role into the mortgage banking world, or banking banking more generally.
I've spent my career in mortgage finance. I started a mortgage brokerage in 1992, just out of college. A couple of years of experience under my belt. Started out of my apartment, bootstrapped it, a couple of bucks borrowed from a friend, and just started writing loans. And a few months later, hired an assistant, took a tiny little office, like a couple of 100 square feet, hired another loan officer, continued to grow the company. And between 1992 and 2004, over that 12-year period, we grew organically to about 1,000 people. We had 65 loan production offices in 25 states. We were doing in excess of $4 billion a year of mostly prime mortgages. And in 2006, well, in 2004, I took the company public. We formed a mortgage REIT and contributed the mortgage bank as a taxable sub of the mortgage REIT. The thesis being, we're going to be the first mortgage REIT that originates its own and securitizes its own loans. Hadn't been done before that. And then, of course, a couple followed on. American Home Mortgage did the same strategy. Mortgage It did the same strategy. And things were going well. So now we had a national mortgage banking platform. We had a New York Stock Exchange traded mortgage REIT parent. And 2006 rolled around, and we started getting buybacks on some of the Alt-A loans we were doing. We never really did subprime, but we had never had a buyback. I mean, maybe one in 12 years. And all of a sudden, in a matter of a few months, I got 3 buybacks. And so it forced me to take just sort of a very sober look at the market. And one of the things that was clear was that property values were skyrocketing, and that the Alt-A lenders, forget the subprime lenders, but even the Alt-A lenders kept having this, this credit creep. First it was 75%, then it was 80, and all of a sudden it's 95, and then you could borrow 125% of your home value, and then you needed good credit, and then you didn't need good credit. So, at the height, you didn't have to have any equity in your home, you didn't have to have a job, and you didn't have to have good credit, and you can borrow money. And the loans that went bad on us were actually sort of, I laugh about it now. They actually talked about it in the movie The Big Short. These loans were 95 LTV loans, 3 of them made to a stripper to buy 3 houses in the Hamptons. And the whole thing was kind of a scam orchestrated by somebody else, but we didn't know that. Like everybody else, if Wall Street would buy the loans, we'd make the loans. And when loans started going bad, it wasn't hard for me to project outward and say, if this is a trend, if this isn't just a one-off, you don't survive that. You only have so much capital. And when you're selling loans in the scratch and dent market, as people on this call probably realize, you don't get par. You get 90 or 80 or 70% of par. So we took our lumps on those 3 loans, and I just started to look at the quality of the Alt-A loans we were originating, and it was only 20% of our volume, but it was clear to me we needed to exit that business. And so I called my national sales manager in, and I said, look, I want to get out of the Alt-A lending business. And he said, the right thing. He says, your company, you can do that, but you're going to lose 500 loan officers if you do, because everybody else is still doing Alt-A loans. And if you're not doing them, nobody's going to want to work here. Mm-hmm. So writing was on the wall. I went to my board at the next meeting, and I said, it's time to sell the company. I said, I don't want to be here when this world comes crashing down. And this was late 2006. And then they looked at me kind of like I was crazy. So we just went public 2 years ago.
Oh, yeah. I mean, it was still a great thing. You had 2006. New Century was. They actually were still open at that point, right?
Everybody was.
Yeah.
2006 was the height. I mean, it was the peak.
Well, 2000 was one Bill Dallas shut down Own It in May of 2006. And that actually, yeah, like that was people like, wait, what? But there was people know. I said, listen, if Bill Dallas, he seems to be able to time these things, so your timing was perfect. So, at the time, what exactly happened? Did you lose all those loan officers? Did they all leave?
No, to the contrary. So, I went to my board and I said, I'd like to sell the company, and we put the entire company on the market, including the mortgage REIT and the mortgage bank. But as it turned out, there weren't a lot of buyers for the mortgage REIT, because the mortgage REIT is really just a leveraged portfolio of mortgage-backed securities, and there wasn't anything that proprietary about it. But we did have bids on the mortgage bank, so we ended up selling the mortgage company, the mortgage bank subsidiary, to IndyMac Bank, and everybody knows what happened to IndyMac. But the staff was excited. They couldn't believe I was selling the company. Some people said, "You're crazy. This is going to be one of the best years we've ever had," and it was a good year. But to me, I had a lot of my net worth wrapped up in this one asset, this mortgage business.
Wow.
And I said, I'd rather ring the bell now and sell to sell to a company that has a different view of the future. And IndyMac Bank is, people might recall, they were the largest thrift blow up in history. It's California-based bank, and they were huge in the Alt-A market. So they had wholesale and correspondent, but they didn't have retail. So it was a big match for them. And I lasted about 10 months at IndyMac, and I resigned very amicably. There were when I got to IndyMac, I think I probably hired close to 1,000 people over the course of 10 months, because at that time we closed the transaction in February of 2007, and now mortgage banks and banks around the country are starting to blow up, and you have hundreds of people, thousands of people being displaced from their current employers, and we were open for business and hiring. So I hired a lot of people, and of course, then the whole economy came crashing down, and obviously IndyMac didn't make it, but I had left prior to then. And so I guess that's a long answer to how did I get into banking. This was February 2007. I sold the company. I think it was October or November 2007 that I left IndyMac, and I got into the health club business, and I got into the real estate development business, and I started doing other things that didn't include fluorescent lights, cubicles, and computers, and loan officers and processors and underwriters, people who I loved and become close friends with. I just needed to do something new. And, and then the recession hit, and every business was hard. And some of my former employees, started pinging me and saying, "Hey, when are you getting back into the mortgage business?" And my answer was never,
Never,
never, ever.
You keep trying to get out.
That's right. You pull me back in. But I couldn't help but seeing what was taking place in the market, and it was very difficult at that time. This is 2008, 9. It's very tough for people to get a mortgage unless you were right down the plate vanilla. There was no Alt-A, there was no subprime, there was no non-QM, wasn't a thing then. And there were a lot of really good lending opportunities to good credit-worthy people who just were disenfranchised by, A, the Dodd-Frank legislation that made it difficult, and B, just lenders didn't have the risk appetite. And so I said, there's a play here, there's a niche to be served, and the idea was, if I'm going to do this again, I'm not going to do it in the form of a mortgage company. Nothing against mortgage bankers, but one of the things that put mortgage bankers out of business was loss of liquidity in the credit crisis. It was hard to get warehouse lines, and even New York Mortgage Trust, my former company, struggled. Even after we sold the mortgage bank, the REIT struggled because it didn't have permanent sources of financing. It was borrowing repo from Wall Street. Yeah. And so when Wall Street froze up, even mortgage REITs and everybody had to start liquidating assets into a market where there was nothing but sellers, no buyers. So everybody started taking haircuts on their assets. But if you're leveraged 5 to 1, 10 to 1, 20 to 1, even if you take a 5-point haircut on the sale of your assets, your equity is going to get wiped out. So I said, if I'm going to get into the mortgage business again, the bank vehicle is the right way to do it, because A, you have a permanent source of sticky liquidity from consumer deposits, Federal Home Loan Bank borrowings, and other sources. B, as a federally chartered bank, you're preempted from licensing in 50 states, so you can automatically lend everywhere, and your loan officers don't have to get licensed. And C, most importantly to me, sort of from an intellectual standpoint, I could diversify. I could do other things. It's not just mortgages. And having never really worked for a bank, I had a lot to learn. But I acquired the bank in George Lazaridis, who was is a friend of mine, and who was the guy that ran my Astoria loan production office for New York Mortgage, my former company. He and I got to talking and said, look, if we're going to do this, let's find a little bank, something small enough that we can afford to buy it and own a controlling interest in it, something that's local so we don't have to move it. It's something that's not too complicated that we can't figure it out. And we went shopping, and I found this little beat up bank in Long Island called Golden First. And it was also
Golden
owned,
First.
also owned by a mortgage guy.
Yeah.
Yeah. So the guy that owned Golden First also had a mortgage company, and he broke a bunch of rules, got himself into some regulatory hot water very, very quickly.
Oh, that's too
And
bad.
so when I found that bank, it was 20 million in assets, 2 million in capital, losing 200,000 a month under a cease and desist order, and it was about to disappear.
Oh,
and so we made a play to buy it, bought it, recapitalized it, brought George and some of my former key people over from my prior company, and we launched this tiny boutique little bank. And our strategy was really to serve the underserved, to find niches where people are being overlooked. And if you're headquartered in New York City, especially in the boroughs, you've got a lot of immigrants and small business owners and gig economy workers, I guess is a newer term, but it was the type of people that earned their livings earned their living in a lumpy or unpredictable payment cash flow stream, and they didn't fit the Fannie Freddie box. So I said, look, as a bank, as long as I could demonstrate to the regulators that the loans I'm making are safe, I don't have to verify income the traditional way. My thesis has always been loan to value and credit in that order rules the day. And if you have a low loan to value and a high credit score, regardless of doc type, full doc, no doc, stated income, and every flavor of it, history has proven, even through the credit crisis, the Great Recession, that loans with a 65 LTV and less, regardless of doc type, had very low loss severities, even through the worst 100-year credit storm we've seen.
Yeah.
So the thesis was niche lending. We have a limited balance sheet. Let's lend to our community, and let's develop a real strong expertise in lending to people who can't necessarily check the Fannie Freddie box, but are good credit risks.
Yeah, and I'm sorry, I didn't mean to cut you off there. Continue.
Yeah, sure.
So I love this story because listen, where the bank, especially where it was, especially in Astoria, everyone has lumpy income. I love that term. Lumpy income and ability to repay don't work well together.
Not usually.
Yeah, and by the way, I do want to actually make a point. Actually, so Steve, thank you. For that correction. Bill Dallas closed on it in December. It was actually our December holiday networking party in Atlanta when we got message that they weren't showing up for their booth that they paid for. We thought that was weird. And Tara, we're going to get to your question a little bit because I do want to ask about that. But so I just got to we got to go into this. So here you are actually with these lumpy income borrowers who have no options, and then actually, of course, non-QM comes along and there opens a door a little bit, but without actually, something that you guys have, which is the CDFI. I think actually that door doesn't fully open for those lumpy borrowers, right?
Yeah. So the CDFI, it's a community development financial institution. It's a U.S. Treasury designation granted to financial institutions that have as their mission lending to low-income families, minorities, or in low-income census tracts. And as it turns out, because we were located in New York City, where there are so many low-income census tracts, we were eligible to become a CDFI. Upwards of 70% of the loans we were making were to people that had household incomes less than 80% of AMI, or were in a low-income census tract. Like, you'd be surprised to know, like Times Square, Manhattan, it's a low-income census tract, believe it or not. There may be billion-dollar skyscrapers, but there are also tenements. There are also, rent-stabilized housing where people of modest means live. So in and around New York City, you have a lot of low-income census tracts. But what we found was, as a CDFI, we're exempt from ATR, which is ability to repay. And so while we don't have to collect literally any income documentation whatsoever, and it's legal for us, with our ATR exemption, even if we don't collect income documentation, we still have the safe harbor that a fully QM compliant loan would have. But it wasn't like we could just throw caution to the wind and do no doc loans, because we are a FDIC insured bank and regulated by the OCC. And so I had to convince my regulators that even though we weren't collecting standard income documentation, these loans are safe. And the way we were able to demonstrate that was by showing them the data that I just referred to through the last credit crisis. LTV and credit equals ability to repay. And not by the Dodd-Frank definition, but by the real world definition. And historical large down payments, even if they fall into financial trouble, either they'll figure out a way to pay or they'll sell the property because they have something to lose. They have equity to lose. Whereas if you're borrowing 95% no doc, you have nothing to lose. So you'll squat in the house. And as everybody knows who does business in New York City, it isn't easy to foreclose in this town. It takes years.
Yeah.
So we really built our niche around what wasn't called non-QM when we started it, but the non-QM name sort of followed. And we believe we have a strong competitive advantage in that area because we don't have to collect 24 months bank statements, which is arduous and sometimes not helpful to the borrower. But a lot of the people we lend to are immigrants, the Asian American community in particular. Not to stereotype, but it does hold true. A lot of families contributing or pooling resources to buy a home, and they oftentimes put down 40-50%, have great credit, but it's hard to figure out how they make their money. There's more than one person behind the scenes contributing to the household. And so the CDFI exemption was meant for people like that. It was meant to be able to empower people who don't fit. The CDFI knows that CDFI institutions are accustomed to dealing in those populations safely and responsibly. So they said, look, you don't have to follow ATR. Do it the way you've always done it. Make it safe, and just help some of these people who wouldn't otherwise get mortgages get mortgages.
So are people walking into, being actually that the rules are very different? Are people walking into your bank because you have a bank location, bank locations? Are people walking into the bank with piles of cash to be able to use towards towards down payment? Is it anything like that?
No, there are laws about that. AML and money laundering.
$9,999 worth of cash.
That's called structuring. No, you have to be able to source the liquidity.
Yeah.
And that standard we're not exempt from, nor would we want to be.
Yeah.
You need to know that the people are using money that's in the system, that's not under their mattress. Oftentimes there's gifts involved, which is fine. We accept 100% gift on these transactions because, again, with a low LTV, I mean, we've been at this for 10 years now, and I think we've had 4 residential loan defaults in 10 years, and in 4 out of 4 cases, we didn't lose a penny because the LTVs were very low. And we have a pretty onerous default rate of 18%. So if you go 90 days down, you get a letter from us saying that if you don't get current, your rate's going to 18%. And generally what happens is people get current. And so it has to hurt, and it's not meant to be punitive. We don't want to collect 18%. We want you to pay.
Yeah.
And so make us a priority because we're small. This is a small business too. This is my capital at play, and I can't afford for, multi-millions of dollars of loan losses. So we have to make decisions as though, you were lending your own money. Would you give this person a loan? And the answer is, if I told you they were putting down 50% and had a 750 credit score, you wouldn't need to know much else.
Yep.
You're getting paid.
Yep. That's their ability to repay. They're gonna figure it away.
Yes.
They came up with that big pile of money for them to be able to put it down on the house. They'll figure out a way to make it happen. So so you said 4 loans went into default. Out of how many? How many total loans?
Billions of dollars worth.
Units wise, and any idea?
I couldn't give it to you off the top of my head, but it's a good number.
It's amazing though. That's fantastic. It's more than 100, so it's definitely less than 4%.
Thousands of loans. I mean, even in we also do commercial real estate lending. We do commercial, mixed use, multifamily, Same principles. We went a little bit out over our skis last year and made a loan on an office building in New Jersey. It was one of the largest loans we've ever made. And guy went into default. But because it was a 65 LTV loan, we just sold the building at a profit 2 weeks ago. Took some time to work through it and a lot of aggravation, but LTV rules the day, which is part of what scares me about what I'm seeing in the non-QM market. Well, today the lights are off, so this commentary may be stale and then relevant again in a few months, hopefully. But as more and more non-QM lenders started to ratchet up their LTVs and ratchet down their FICOs, it just sort of smacked of the old Alt-A days where, there's an insatiable appetite for yield and anybody would securitize anything. And so, we'll, regardless of whether the market will buy a 90 LTV bank statement loan, it's not our thing. We like low LTV, we like good credit, and we're going to stick to our discipline there.
All right. So listen, let's look at so 2008. You basically said, all right, how do we re-engineer this so a black swan happens, it's not going to impact us? And you figured out actually, hey, that by having a bank to kind of prepare us for when there's no liquidity, it would put you into a better position. So obviously you didn't have a chance to really stress test this, but here we are. And how is that impacted, because you have the bank and you have actually, the product, how has that impacted your ability to sleep at night, Steve?
A great question. So unpack some of that. First of all, the loans we own, again, are largely low LTV loans. That said, we are in New York City, which is the epicenter of the coronavirus, at least in the U.S. And we've had a very high percentage of our borrowers ask for deferments. And so I would say upwards of 30%. I think the national average is still under 10% if it's being reported accurately and growing. But regionally, those numbers are pretty consistent with what I'm hearing from other banks. And so normally I'd be scared, because if you have so many people that have been adversely impacted by COVID to the point where they need a deferment, I would wonder, well, what happens when the economy turns back on? And if these people don't get their footings under them, their feet under them quickly, are they going to be able to re-perform after the deferment period ends? And I don't think anybody knows the answer to that question yet. I'm optimistic, but I'm also still a little worried. But the fact is, we still have a low LTV portfolio. The only thing different this time versus normal times is I would feel horrible having to foreclose on someone that, did everything right. They put down a lot of money, they had good credit, and now the whole swath of jobs are just eliminated and don't come back. That's sad. I never really felt bad for the homeowner that put down 5%, no doc with 600 credit score. You shouldn't have had that house in the first place. But this time could be different. So I think we're insulated from a loss standpoint because of the average LTV on our balance sheet is 63%. The average credit score is about 740. So hopefully everybody goes back to work and starts paying. But if they don't, then we're going to be having a lot of very difficult conversations with people. The other impact that's been pretty severe is we're also a very active non-QM lender, and we don't hold it all on their balance sheet because we have limited capacity. We sell it into the secondary market like everybody else who does non-QM lending. And as everyone knows, that market's completely frozen. Well, not completely, but it was completely frozen, and you're starting to see some little glimmers of hope in certain places. But absent our ability to sell these loans into the secondary market, our ability to continue making them.
Oh.
Do not disturb.
Oh, I got you back. Great.
Can you see me?
Yep, I see you. Can you see me? Yep. Can you hear me? See me? Can you hear me?
Yeah, Andrew, I can't hear you for some reason.
So try to refresh your browser, refresh the browser. So basically what ends up happening is Steve is at a bank. And
I can't hear you.
Can't hear me. Hit me in the private chat. Hopefully you can hear me. Can you see me? Oops. refresh your mobile browser. Sorry, everyone. Hopefully he'll get that message and hit refresh. One of the interesting things is when you're a bank, everything is locked down. Everything is completely locked down. So you've as I've learned with AmBiz, so now actually it's not just a mortgage publication, but we're also in the banking space, and most banks have everything completely locked down. So being able to go to a browser that will let you stream live on Facebook, YouTube, and Twitter is probably something that most banks are going to lock down. So Steve, even as the CEO and chairperson of Quontic Bank, still has his things locked down, and he has to use his phone to connect. So I'm going to get him back in here. Steve, can you hear me? All right. I hear you. Or I see you. I don't hear you, though. Sorry, guys. I think you have me in your earbuds. Can't hear me. You can hear me. Okay. Hold on for a second, guys. Let's make sure. And mute and unmute. How about now? I can't hear you. So sorry, folks. Thanks, everyone, for your patience. Again, when we're dealing with banks, unfortunately, they lock down their firewall, so everyone has to use, when you're doing these lives from a bank, they actually have to use their phone. So hopefully we'll get Steve back here. Got a lot more I got to ask him as far as questions. I'm really, really excited to hold on. Steve, can you hear me now? And I can't hear you. Right. Hold on for a second. As crazy as it sounds, Steve, do you want to call me on from your office phone on your cell, like call my cell phone? I'm sorry, folks. Thank you, everyone, for your patience. I apologize, but I think. All right. Hey, Steve, if you can hit me, there's a little chat, a little private chat on the app that you should see on the StreamYard app. Hopefully, you can see me over there. Okay, you can hear me. I can't hear you, which is, it's more important that we hear you than me, I think. So refresh. Oh, so you can hear me. I don't need to type. Refresh the browser and then try to connect. Let's see if that works. Give it one more shot. Thank you, everyone, for sticking around. I still see people actually are staying, even as actually the streaming technology has fumbled. Certainly, it's not the first time and won't be the last time. We're dealing with so many different variations of technology. All right, I'm going to try to bring Steve in. He's just joined us in the studio again. All right, how about now? I can't hear you. I wonder actually if it has something to do. Maybe the AirPods. Take the AirPods out and put them back in. Sometimes it'll disconnect and reconnect, and sometimes that can help. And give that a shot, and then if that doesn't work, maybe shut off Bluetooth and use like the speaker on your phone. If that doesn't work, we're going to throw in the towel on this. But I think you've got a great story, and hopefully we can figure this out here. Thank you, everyone, for sticking around. Really, really curious on oh, he's on speakerphone now. All right, can't. Okay. Steve, can you hear me? All right. Do me a favor. You have my cell phone number. Call me on my cell phone. We're gonna finish it up on the cell phone. Everyone, I apologize, but I appreciate you sticking with us as we go through this. Hey, Steve.
Yeah, can you hear me?
Yep, I can hear you. And hold on for a second. Got you on speakerphone here. So if anyone could tell me actually if you could hear Steve. So if someone in the room, tell us if you hear Steve.
Hello, can you hear me?
Yep, I hear you perfect.
Okay.
All right, fantastic.
All right, me too.
I love this actually. This just came from Martin. Is Munchin censoring Steve? What a great interview. Listen, awesome. See, we're working in uncertain times, and I feel like actually that character from oh my goodness, the where it was he was traveling around like a roving reporter that was being shut down by the government. Okay, everyone's hearing us loud and clear. We got permission to proceed. All right, so continuing on with this, I got to ask you. So let's go back actually. So how you guys are handling and how being a bank has made you prepared, to deal with this situation that we're dealing with now. I know you said actually, you talked about actually how obviously for your portfolio loans, how those are being handled. You were doing a lot of non-QM loans, and those non-QM loans you were originating for other entities, right?
Well, we were originating. The genesis of our starting into this business was to originate them for balance sheet. As a bank without a lot of branches, we had to pay up for our deposits. So, if our deposit cost was higher, that means our asset yields needed to be higher. So the idea was originate what are now called non-QM loans for balance sheet, and we'd still see a nice net interest spread between our deposit or borrowing costs and our asset yields. But we started originating more than we could potentially or possibly keep on balance sheet. So then, like everyone, we started selling them into the secondary market, and it's a very lucrative business. Anybody who's engaged in non-QM had a good run until the lights went off. But we're still doing non-QM. We have a limited amount of balance sheet for our no ratio product. We're also, for the first time ever now, doing bank statement loans. We weren't before because we do have some liquidity for bank statement loans. And, we're just being very cautious now. On our no ratio loans, we're maxing at a 60 LTV, 700 minimum credit score. We're requiring that the borrower put up 6 to 12 months PD in a checking account, which they have to keep with us for 12 months until they prove 12 months timely mortgage payments. And on the bank statement loans, similarly, we go to 60 LTV. And, the rates are higher than they were before the coronavirus. And hopefully they go back down, but we're still seeing demand for it, even at these rates and low LTVs.
Fantastic. So I mean, if you don't mind, like how high are we talking as far as these rates? Are they a hard money rate level? Is that what level are you seeing rates at now?
Mid sixes.
That's
so it's
not
not
bad.
terrible.
No, not bad at all.
Yeah, considering the rates were like in the high fives before. So I see other non-QM lenders tiptoeing back in. I think Angel Oak came in and the rates are very, very high. I mean, they have a differentiated product. And there are a couple of others that have stepped back into the market. But, one of my concerns about lending money in the sevens for an owner-occupant is as soon as the lights come back on, those people are going to refinance and pay you off.
Yeah.
So, rates in the mid-sixes, I think, are palatable. We're getting paid for the illiquidity risk that we're taking by making the loans, and the consumer is getting to buy their home or to refinance. We're still doing cash outs, although, not very, very conservatively because of the low LTVs. and we're verifying that the borrowers is still either employed or that they're self-employed and not adversely impacted by COVID, which everybody is impacted in some ways, but there's this whole alternative economy where some people are actually benefiting from this new weird situation we're in, and we're requiring all the borrowers to sign an attestation, basically saying that they're not in forbearance on any loan anywhere else, that they understand they're not going to get a forbearance for us, nor do they need one, that their business is still operating, they're still earning enough money to make their mortgage payments, and of course the low LTV and the high credit score prevail here as well.
Wow, that's so. Listen, I mean, it sounds really, really safe loans. You're giving it actually, to you're not going to give it to just anyone. You're being selective about who you guys are giving these loans to. So I'm curious if you could share with us some of the industries that you see are having a boom, from a borrower perspective. I mean, because these are great prospecting opportunities. Any insights on what industries that you think are really good businesses to prospect right now?
Well, I mean, on the grander scale, your Amazons, your Netflixes, your grocery stores. But on the local level, the entire city is shut down, and there aren't a lot of businesses doing well. But there are a lot of restaurants that are still open. Some of them that are doing takeout and delivery are still doing okay and not great. And there are professional service providers, lawyers, accountants. Financial professionals. There are still a number of people that are still gainfully employed, earning what they were. All of my employees who are here are still earning what they were earning before COVID, and there are a lot of businesses like that where people are still employed. The self-employment scene, it's a little dicier, but in some ways we're relying on people to say, look, I'm willing to put down 40%. I'm willing to put 12 months pity or 6 months pity in a non-interest bearing checking account that's frozen for 12 months to be released only upon my making 12 consecutive timely payments. And for borrowers who are willing to do that, in some way you're taking a little bit of a leap of faith that they wouldn't do. Nobody's going to put down 40%, sign an attestation that they don't need a forbearance, and then stop and then not pay, especially when you're holding 12 months of their money to ensure that they do. So, look, if this lockdown lasts 6-12 more months, all bets are off. We probably stop lending like everybody else, and then the economy goes into a horse tailspin. But most governments are starting to loosen the reins a little bit. Some people are, in certain pockets of the country being let out to go to work, and we do a national lending business. Fortunately, we're not just New York City. There are other parts of the country, as you know, which were not as impacted as severely as New York City was. And so we're finding a lot of opportunities outside of this our primary market as well.
Great. So I mean, and that's great to hear. Are there any hotbeds of activity that you're seeing opportunities around the country?
I don't think any real trends have emerged yet for us geographically. We're doing too little outside of the New York metro area to really be able to decipher if there's one market that's stronger than the other just yet. So for us, we've always been sort of geographically agnostic. We tend to focus more on the borrower specifically. And again, historically, like I said, I'll say it again, people who put down very large down payments and have great credit, which is illustrative of somebody who pays their bills on time no matter what, those are risks we're willing to take.
Fantastic. So I know you guys use brokers a lot to put that product out in the street. What are the advantages that you see with using brokers? And tell us actually, where do you see the biggest opportunity in the future? Is it, the retail growth, or is it, using brokers in the wholesale and maybe even correspondent?
So we like the broker channel because it gives us a geographic dispersion. And while it's not so important to us that we're geographically diversified, the people we're selling our loans to like to see a geographic dispersion because mostly, the big securitizers tend to get a whole lot of California and New York just because of how big those markets are. Sure. So wholesale gives us access to the whole country. And we just reopened wholesale this week just for the bank statement product. We hope to reopen it soon for the no ratio product too, but we're going to need a little bit of relief from the market before we can do that.
Fantastic. Listen, great opportunity with you guys. I think I've always been amazed actually at the statements about the kind of products that you guys offer, but then when you break down actually the demonstrated ability to pay by coming up with huge sums of money for down payments, it all makes sense. And just considering actually where these products have been spawned from, which is in New York, where everyone has that lumpy income that you talk about, which I think it's a great way to put it. So listen, Steve, I really appreciate what's the best way to get a hold of you guys if brokers watching this and they want to get signed up with Quontic Bank. What's the best way to get a hold of you guys?
Wholesale. What's our wholesale address? Wholesale@QuonticBank.com. I'll send you an email, Andrew, and you can blast it out.
Okay, fantastic. And everyone, we'll put it in the comments below, whether on watching this on Facebook or YouTube. So, Steve, thank you for hanging with us and seeing us through the technical issues. We really appreciate it.
My pleasure. Have a great day.
Okay, fantastic. And just stick around for just a minute. All right, everyone. We made it through. Very cool. So really glad that Steve was able to join us for that. What an unbelievable location. I can't believe actually that Rockefeller Center just has no one there right now. Amazing stuff. So super excited. Tomorrow you're going to join us, Mortgage Leadership Outlook, Kevin Perenio from PRMG, the Chief Lending Officer of one of the most loved brands in the mortgage business. So excited for you to join us for that. And then for Thursday, we're wrapping up with Ted Tozer, former president and CEO of Ginnie Mae. Everyone, thank you so much for watching. We really appreciate it, and we will see you here tomorrow.